But the conversation surely shifts now to the possibility of a bank in Italy that does face some resolution and may being the key word here, may have to bail in bondholders. How significant would that be to you?
Well, again, it's breaking right now, but I think that everybody is well aware of the challenges in the banking sector in Europe, and that's one of the reasons why European markets have struggled so much relative to other global markets. I think the fact, at least from what it looks like right now, that we're not seeing a broader risk-off move across U.S. futures or even broader European stocks tells you that investors are not looking at this the same way they may have been 12 or 18 months ago when this sort of headline would have sent markets into a panic.
Why do you think it's not sending markets into a panic?
I think what we're seeing now is a broader-based global economy that has much better footing. We've shifted away from the playbook over the last couple of years that was based on monetary policy, deflation, low growth, to a more reflationary, better growth environment. And if you think about that, that's supportive of the banking sector. Higher rates globally are a good thing for banks. So I think investors are looking at this certainly as a risk, but also recognizing that there's a lot of other positives going on in the world that mean that this can probably be more isolated than they may have thought in the past.
So steepening yield curve, good for European banks overall. We saw the stocks react yesterday, but take us into Italy, specifically the Italian banking sector. If there are these difficulties with Monte Paschi, as there are, how much does that tell us about the rest of the Italian banking sector? What questions does it raise about other Italian banks?
Well, I mean, I'm certainly not an expert on the Italian banking sector, but we've seen this story play out multiple times over the last couple of years, and I think in some ways reaching some sort of resolution around this, who knows what that will be, but that probably brings some stability to markets. To me, I'm less focused on Italy and Italian banks specifically, but on some of the opportunities in Europe more broadly. Yeah,
well, you're surely focused on global politics, and for me, there is a clear line here that needs to be reconciled. It's the rules that are set in Europe and the politics as they emerge in places like Italy. The rules right now say that if you can't raise capital and you need state aid, well, that means you're going to have to bail in shareholders and bondholders as well. A lot of those bonds are held by retail money in Italy. That's going to create a political problem at a time when Italy is set to go back to the polls within the next 12 to 18 months. The politics in Europe, what does that mean for your world?
Well, one, I think that the challenges of the Italian banking sector and the fact that it is the retail client base that is the holder of so much of this debt has been one of the things that has caused this to drag on for so long, and the reason why they haven't been willing to take the pain. I think if this year has taught us anything, it's that trying to invest based on politics, guessing outcomes and how markets will react, whether it was Brexit, whether it was the US presidential election, that's really not the way that we're thinking about investing money for portfolio, for our clients. I think that the political situation in Europe may create an opportunity for us because the fundamentals are really about growth, and that, I think, is in better shape.
We've seen the move in the equity. Just to get you up to speed for our viewers out there, this is the move in the debt on the Bloomberg, and I can bring it up for you. Monte Paschi debt just rolling over, down about 7 cents on the euro. That's a big move, David. We now trade at 54.614. So the equity rolling over, but the debt rolling over a lot more viciously. The why? Because if you do have to reach for state aid, and of course we have no confirmation that that is happening right now, but you can look at the theory. If you do have to do that, you have to bail in these guys.
Well, and it leads exactly back to the point, which is, Stephen, it makes sense. It's hard to invest anticipating what happens in politics because it surprises you so often, but you have to invest in a way so that when politics come to play, and you're one of those bondholders, for example, of Monte Paschi right now, you're prepared. So how do you approach that? And this is true in the United States as well as in Europe.
When we think about how we're building a portfolio for clients, I'm trying to put politics and any sort of guesses about policy and what that's going to mean to the side. So, for example, you think about the U.S., everybody's getting really excited about potential for tax cut, deregulation, repatriation. And because of that, there's a lot of animal spirits that are creeping up. To me, I say, if you put that aside and just look at the fundamentals, you look at the fact that earnings are starting to reaccelerate because the economy is getting better. If you look at the fact that even if you get just some of that positive policy, we're looking at mid-single-digit types of earnings growth, that can get you a good year for equities. To me, I like to say that a lot, the Goldilocks scenario where we get all of that policy, those tailwinds, that gives you upside, but you don't build based on that sort of view.